This is the FlipNerd.com Expert Real Estate Investing Show, the show for real estate investors, whether you're a veteran or brand new. I'm your host, Mike Hambright, and each week I bring you a new expert guest that will share their knowledge and lessons with you. If you're excited about real estate investing, believe in personal responsibility, and taking control of your life and financial destiny, you're in the right place. This is episode number 429, and my guest today is Nick Legamaro. Nick is a seasoned investor in the Dallas-Fort Worth market, here where I'm at, and he's an expert at the owner finance or the seller finance model. Now, many of us got into real estate investing or get into real estate investing to build long-term wealth, usually with rental properties. However, owning rental properties can also be a pain. I can tell you that firsthand. But it's a great model, but there might be something better. The seller finance model serves a big need in the marketplace and is perhaps one of the best wealth building strategies for single family home real estate investors, especially in affordable housing markets. You ready to learn all about the seller finance model? Please help me welcome Nick Legamaro to the show. Nick, welcome to the show.
Hey, Mike, thanks for having me.
Yeah, good to see you. Good to see you. You know, a lot of folks, I say this sometimes when we're starting a show, like you and I have been talking here for a half hour, like catching up and stuff. So it's really good to have you back, or you haven't been on the show before, but good to see you here. And it's also, I'm really excited to talk about seller financing today. I've started to do some myself. When I look back over 10 years and hundreds of deals, I wish I had done more of it. And you're an old pro now, so.
I don't know about an old pro, but I have done several hundred of them. So
yeah. So
more than most.
It really is a great model for a lot of reasons, and I'm excited to share that with our listeners today. So before we jump into kind of talking about all that we can possibly squeeze into a show on seller financing, why don't you tell folks your background and how you got to where you are?
Yeah, so I started in real estate probably in the early 2000s, probably 01, 02. And back then, there just wasn't a whole lot going on as far as education, knowledge, REI clubs. I think there was one I can remember, and it went away, didn't last very long. So just the internet was just starting up. No, it was around for a while, but the information just really wasn't readily available. You know, there's a couple late night TV kind of shows and stuff like that. But I did what a lot of people did back then, which was basically fix and flip. And my fix and flip model was really geared around, I didn't have a lot of money, didn't understand the business, I didn't have a lot of teachers, for lack of a better word, or mentors. And so it was all really lower price point stuff. We'd buy it, we'd do a little low rent grade rehab, and I'd sell it to an investors, get my cash back out and repeat the process. Well, then 07, 08 comes around the corner and all hell breaks loose, as everybody knows. And that was, I was fortunate enough to get out fairly unscathed, but I go, well, this is not going to work. And it literally took probably about 3 years off till probably 2011. I knew real estate was where I wanted to go, wanted to begin full time again. And I said, well, I have to forget everything I know because I can't afford to have that same situation happen again. There's got to be a better mousetrap, for lack of a better word. So I said, I'm going to forget everything I know. I'm going to start educating myself because now real estate had become real hot, right? So there was plenty of people out there that were the so-called experts and the so-called gurus and information all over the place. There's a different seminar going on every weekend, it seemed like. So I said, I'm just going to really figure out what makes the most sense to me. And I looked at everything, looked at all kinds of different strategies. And what it eventually boiled down to was wholesaling. And wholesaling both, trying to find properties on market as well as off market. And it made a lot of sense to me because it was something that was very scalable. It made a lot of sense to me. And as I know today, which I didn't necessarily know then, is that everything starts with the deal. No matter what type of real estate you want to be involved in, whether you want to be a buy and hold investor or a fix and flipper or a wholesaler or a lender, all of them, doesn't matter. If you don't have a property to begin with, you don't have a deal. Yeah. So, and that's what we're realizing today. So now it's sort of shifted back to there where some of the focus on the strategies is we're really trying to find, it's really about sourcing inventory so we can do any strategies that we choose to do.
If you're an active real estate investor already doing deals and looking to double or triple your business, you should consider joining the Investor Fuel Real Estate Investor Mastermind. We're a small group of investors that share our best practices, tips, and tricks with one another in an effort to all win. We limit our membership to only 1 to 2 members per market, so everyone shares their knowledge, tips, and tricks openly and honestly. Our members include some buying 1 to 2 houses a month, up to some of the most respected investors and leaders in the real estate investing industry, some of which have personally done over 1,000 deals. If you'd like to be considered for our invitation-only world-class mastermind, please visit investorfuel.com to request your personal invitation. Our next meeting is coming up quickly. Go to investorfuel.com now to learn more.
And that's what we're realizing today. So now it's sort of shifted back to there, where some of the focus on the strategies is we're really trying to find, it's really about sourcing inventory so we can do any strategies that we choose to do.
Yeah, wholesaling is the foundation of this industry, right? The distressed property industry. Like if you're doing retail grade properties, you're effectively just in the space with builders, right? So you've got to find the deal, which is a property at a wholesale price that makes sense, right?
Correct.
Yeah. And then from there, there's a lot of things you could do, right? And so once you find the deal, or you get good at finding deals, then it's a matter of what are you going to do with them? So historically, I've fixed and flipped, keep some houses as rentals, wholesale some, assign a bunch, things like that. And you did that too for a while, right?
Yeah, absolutely. That was what I intended to start doing from the very beginning.
Right.
And that's what I did do. And the funny part about it is I'm more into seller financing now, and actually what happened is the second deal I ever got through direct mail that was wholesaling was a property back then in 2011. You could get a property for 30 or 40 grand. Sure. I'm in the Dallas market. And it would be exactly what you would think it would be. It'd be a little 2-bedroom, 1-bath, little 750 square foot house, and built in 1950. And the lady goes, I just want out of it. I owe $25,000 on it. I don't want any money on it. I just want to go out of it. And I had no idea what it was worth. I got a realtor involved, and they told me it's probably worth 50 grand. I go, okay, well, they want 25. It's worth 50. I'm probably not going to find somebody that's going to give me $50,000 cash for it. I didn't think, I know a lot more now than I did then.
Right.
I said, and I talked to somebody. I go, hey, I got a house for sale. I go, if I want $50,000 for it, do you think you can find somebody that's got $25,000 put down on it? And I financed the difference. And long story short, that is what we end up doing. So at the end of the transaction, I basically made zero cash on the transaction, paid off the underlying debt for the seller, paid off a little bit of money to the person to help me market the property, and then I was left with basically a note that I had created on rate and term for. It's gone now. They since paid it off early because I gave them too good of a deal. That doesn't happen anymore. But that's sort of how it evolved. And I started asking the question. I go, well, I started just doing research and trying to find this stuff out. And I go, man, there's a lot of people out there that what we call cash rich and credit poor. They have a lot of cash and they want to buy, but they don't necessarily have the credit to be able to do so. Right. Then I started looking in even more and getting even more technical about it and finding out, like, even today, I haven't checked it recently, but as recently as January, the average decline credit score was like 707. I mean, that's pretty high. I mean, a 700 credit score is fairly high, but for that to be declined for a home mortgage from a B of A or Wells Fargo or Chase or wherever it might be, that struck me as a little bit odd, and I started thinking even more about it. And I go, what's changed today than 10 years ago? Well, there's a lot of people like yourself and myself included that are very entrepreneurial now. They work for themselves. They create their own opportunities. It's very difficult for somebody like myself that's not a W-2 employee that has a pretty job at Frito-Lay to run down to the Wells Fargo and say, hey, I want to buy a house. So, we've created this opportunity to really focus on servicing a community of people that really want to have home ownership, that are hardworking, but just don't meet don't check all the boxes.
Right.
You
Absolutely.
know, from a borrower's perspective, to be able to go out and get a home loan, and that's really how it sort of evolved and moved up to the point that we are today.
Yeah, there's a lot of people too. There's new entrepreneurs. I remember when I first went into business for myself, I wasn't bankable, right? I didn't have 2 years tax returns. Even though my business was doing well, it's like I didn't have enough track record for a lender to care. There's a lot of Hispanic folks that just don't use credit as widely as a lot of other Americans. So they may not have bad credit. They just don't have established credit, right? They just have never used it the way that we traditionally use credit cards. There's a lot of folks out there, right?
Well, and there's, you know, and you brought up a point. You know, not only are there the people that have the cash but not the credit, but there's also a lot of people that are here in the United States that come here to work, but they're not citizens, and they don't have a Social Security number, which is one of the main criterias to going down and getting a traditional, you know, loan. So, you know, whether they're from China or India or Australia or Canada or Mexico or wherever, you know, they come here and they work in the United States, they pay taxes in the United States, they have an international tax identification number, but they can't go down and go buy a home. And that's one of the voids that we try to fill by providing our services, you know, up to a certain price point. You know, we're not doing high end stuff. You know, it's the median home price is maybe a little bit 10% under that is really
Sure.
the market that we're really trying to.
And there's also people that have come downstream, right? Like they lived in a bigger house, had some financial troubles, their credit's all screwed up. They can afford half a house that they used to have, but a traditional lender is not going to finance that.
Yeah, very true. Very true.
Yeah. So let's talk a little bit about, you know, why you as an investor, or people that are listening to this, why they would sell or finance. I mean, it's really kind of a comparison with buy and hold, right? I could keep it as a rental,
Sure.
or I could sell or finance it and effectively be the bank, right?
Well, that's what we are, you know, be the bank, and that's what we try to do. And there's a reason why banks are in the banking business, because they can. At the end of the day, they don't have to go own property. As a matter of fact, banks just don't do it, not intentionally, right?
Right.
In fact, even though it's a good deal, when something comes back in a foreclosure situation and they get it back, they can turn around and sell it because they're not allowed to hold the property. But even if they could, they wouldn't want to, because when you look at what amortization is and how you get paid all your interest up front on a loan, I mean, it takes, if you have a home mortgage, it takes over 23 years to get to a 50-50 tipping point where that payment, because the payment never changes, right, unless you do a refi. So let's call the payment $1,000 a month. Well, in the first year of that payment, $990 is going to interest and $10 is going to principal, right? You're still making that same $1,000 a month payment for the next 30 years. Well, once you get to year 23, then only then are you actually making a $500 a month payment towards the principal and a $500 a month payment to
Wow, that's
interest.
crazy.
So negatively skewed. I don't know who put that rule in place. I don't know how it got approved.
Well,
but
bankers, right?
Yeah, well, that's what it boils down to. So at the end of the day, it's something that we want to participate in, because I want to get all my money up front too. And you know, there's nothing wrong with buy and hold. A lot of people do it. I mean, if I was 20 years younger, I probably would have some more in my portfolio. But the truth of the matter is, I like the fact that I like to be in the bank, and by being in the bank, I don't get any phone calls. I mean, I got a mortgage on my home with Bank of America, and I got such a good deal, and I still owe a little bit of money on it. But in theory, I've had it for maybe 15 or 20 years. I don't know the exact number, but I can't tell you the last time I ever called them for anything. Just don't call the lender. You just don't call the bank. I don't get phone calls from my borrowers. It just doesn't happen, you know.
It's that owner mentality, right? You're like, well, I
Absolutely.
own it, so therefore I'm responsible. When you're a tenant, you're like, it's just easy to pick up the phone to say, hey, this or that doesn't work, or this knob fell off in the tub, or
yeah, exactly.
Yeah.
So, you know, and people go, well, the cash flow is better on a buy and hold. Well, that's maybe true, but you got to remember, it's what happens when the house vacates. What happens when there's deferred maintenance? What happens? You know, there's a lot of what ifs. I like the known. I like when it's my money or I'm actually borrowing money. I really like to deal with known quantities, and I think I like what seller financing or holding a note, because you don't have to sell a finance. You can even buy notes. We buy notes all the time from people that go write paper and it's another exit strategy to get cash out. In fact, that's what we did in early on, is that not until recently was I able to keep the notes that we were writing. I wrote hundreds and hundreds of notes where I would find the property, I'd fix the property, I'd sell the property, I'd write the note on the property, and then I'd sell the note to get my capital back out so I could redo it again. And I sold hundreds of notes that way. And as a result of that, it just allowed me the ability to make even a little bit more money than if I would have just taken that same property and wholesale. For example, that one house that I found, if I would have wholesaled it, let's call it, the profit would have been a $5,000 assignment fee. Well, by doing that little bit of extra work of fixing it, selling it, finding a buyer, that profit from that one same property would be 3 or 4 times the return. So it would be, instead of $5,000, maybe 15 or 20. Instead of selling it in a week, it took me maybe 30 or 45 days. So, but with the limited number of properties, it was the right thing to do. Now I want to hold the notes, obviously, for as much as possible, because there's a lot more money, even longer term, because I can defer that profitability on the deal for a long, long time.
Yeah. I think most investors get to a point to where pretty quickly, in fact, I had somebody that I was talking to earlier today, and they've done lots of deals, hundreds of deals, a lot of experience. And they just said, I'm tired of working that hard. Right. And their primary model has been fix and flip and some wholesales. And there's nothing wrong with that. Like, I've been doing this for 10 years, but you do get to a point to where you're just like, how do I, nobody gets in this. I would say probably nobody gets into this business. I know sometimes people glamorize wholesaling, and it's a good business, but nobody gets into this business to say, I want to be in a hamster wheel where I have to work as hard for my 100th deal as I did for my first deal, right?
Well, it's a job, right? I mean, we want to try to turn this into, something as passive as we possibly can. And even in a buy and hold strategy, there's still not a lot of things, in my opinion, in my definition of being passive as a buy and hold investor.
Yeah.
You're still dealing with tenants, you're still dealing with property managers, still dealing with vacancies, liability.
All the taxes, all the baloney.
There's always something, something. And I'm not saying that it's not profitable, because there's a lot of people that make a lot of money in the rental game, but I also know people that have 25, 50, 100 property portfolios and don't make a nickel. It doesn't take much to have that thing go the wrong direction. So, there again, to each their own. There's a lot of look, there's in real estate, there's 50 different ways to make money and be profitable and make a good living in investing. It's just which road do you want to choose to go down, and what do you like to do, and what makes the most sense for you. And it's also, a lot of it's also economy driven, a lot of it's market driven. I mean, there's certain areas that here's a perfect example. Okay. I'm in Dallas, Texas. So let's just take $1,000 property, $100,000 property, for example, in Dallas. Okay. And let's just say for that $100,000 property in Dallas, if I was to rent that property, the rent for that property would probably be $1,200–1,300 a month. I go to some place like Phoenix, Arizona, and there's that same $100,000 price point. The rent value on that property is probably going to be $750 to $850. It's going up a little bit. So you're talking about a $400 swing in value between cash flow, right? Well, sure. When you sell or finance, one of our main objectives is to really be able to put that buyer in that property to equal to or less of cost of renting that like property. So I can sell or finance that $100,000 property for $1,200–1,300 a month in Dallas. If I was going to go buy that same $100,000 a month property in, say, Phoenix or another market, I'd only get $850 maybe max a month. The reason why it works in the Texas market is because property taxes are very, very high here.
Sure. Yeah.
So as a buy and hold investor in the state of Texas, where the property taxes are high because there's no state income tax, is that the rents are forced higher because as an investor you want to recover your cost basis to basically pay for your property taxes and your insurance. So that works to my advantage in the state of Texas, because now I'm going to pass that on to the end buyer, because they're going to have to pay that anyway.
They're the owner. So they've got to escrow that now.
You have to pay for it anyway.
Yep. Yeah. So the biggest pros and cons are, and I can tell you, for a fact, and I think every buy and hold investor would agree, my two biggest expenses by far for rental properties: vacancy and make ready, turnover, right? And so those are the two of the biggest things you eliminate in the seller finance model, right? You're trying to get somebody in there that's paying close to for a mortgage payment what they would pay for rent, but they're owning it now, so they're kind of moving in the direction of building up their asset, right? But they're now responsible for maintenance, and they're now responsible. There shouldn't be any vacancy unless you have to, I guess, foreclose on them, or unless they vacate and abandon the property and leave you on the hook. But for the most part, you've just eliminated your two biggest expenses, right?
Yeah. I mean, there's always a chance of
the third is taxes, right?
Sure.
Yeah.
I mean, there's always a risk of default by the borrower.
Sure.
There's always a chance of having to take the property back. But if you price it right, you buy it right, and you get a large enough down payment, that same $100,000 example that I shared with you, let's just say that for argument's sake that my cost basis was $80,000. So I buy it for 80, I fix it. I'm in it for 80, but I'm selling it for 100. So there's obviously there's an equity position in that property in some capacity, because I only borrowed 80, or used $80,000 of my own money. I sold it to you or somebody else for 100,000. Well, not only did I sell it for $100,000, I'm also going to get a down payment. Right. Let's just say I get 15% down. So now, the note balance drops down to $85,000 to the borrower. It's still worth 100. The value doesn't change. My cost basis drops from $80,000 down to $65,000, because now I'm only exposed $65,000 because I just got $15,000 down payment.
Sure.
So if you look at it, look ahead 1 year, for example, so now I owe $65,000 in debt, whether it's my money or borrowed money, it really makes no difference. I have a house for $100,000. Let's just use round math. Let's just say the interest expense on that is $8,000 a year, right? So if I apply all of that interest to the $65,000, which is $8,000 that goes right to the bottom line, that's going to drop down by $8,000. Now the effective cost basis just dropped down. 8,000 off 65 is roughly 57,000. The note balance didn't change much. It's still roughly going to be $84 to $85,000.
Right.
But maybe the property value has also gone up a little bit. So now the property value, maybe it only goes up to $105,000. So now I have a $105,000 asset that I have a lien against. I don't own it, but I control it because I have the lien. But I only owe technically 65. So in the event that defaults, how difficult is it for me to go get more than $65,000, for example, on something that's worth $105,000, especially in this market? It just doesn't happen. So even if I had to go buy it back in foreclosure at $80,000 or $85,000, I still have my profit I made on the deal when I turn around and resell it. So
yeah. So let's talk. We talked a few minutes ago about like who buys from people without good credit. Let's talk a little bit about kind of why they buy from you, because what we haven't said yet is when you seller finance, the interest rates that you charge are higher than a government subsidized loan, right? So government subsidized loans now 5.5%. Rates went up here recently, but you're able to. I mean, everybody needs to understand that when the government is in subsidizing something, it brings prices and rates down. But if you don't qualify for that, you're willing to pay more to have a home. So kind of talk about that scenario and why they would be willing to pay a lot higher interest rate.
Well, it's a great question, and we ask all the time. Well, why would somebody pay you 9.5%, 10% interest rate on a loan? Well, because that's what the going rate is for them to be able to qualify under the terms and conditions that are set forth to be able to do. We don't have a prepayment penalty on anything that we do. If you want to go refinance out and go down to Wells Fargo, God bless you. We don't tell, they can go get lending anywhere. But at the end of the day, it really boils down to this in our equation. What's the interest rate on rent? Okay. If I'm going to sell you a house and it's going to cost you $1,000 a month and I'm charging you 10% interest, I can show you value in that transaction as a borrower. You're going to eventually owe this property at some point in time in the future, and it's going to be worth something of value. Not even taking into consideration the tax advantages that you get. You get to deduct the mortgage and the mortgage interest. You get to deduct the property taxes. You get to deduct all that off your income tax. But what is the value of that you're getting when you rent a property for $1,000 a month from a landlord? What's the interest rate on that? Well, it's infinite because you don't get any value back out of it. Right. You get nothing. So But this model, you can make that argument when you're able to keep rent, the cost of borrowing and having home ownership fairly similar to rent. Now, that argument doesn't work as much when I say, well, you can own it for $1,500 a month, or you can rent it for $1,000, because then it becomes much more of a subjective discussion or argument at that point in time.
Sure.
So, at the end of the day, most people they want home ownership. They've been told time and time again they can't do it because that's what everybody has told them, and at the end of the day, it's just not true.
Yeah, and it's maybe a good scenario or a good analogy is, I'm a Dallas Stars fan with season ticket holders, so we go to the hockey game, and this is the same thing if you go to the movies, I guess. But when you go there, a bottle of water is $4.50, right? Now, I could have stopped at a gas station on the way there. Of course, I'm not supposed to bring it in, but I could have bought that same bottle of water for maybe a 99 cents or something, right? $1.50 maybe, right? But they've got me there. This is my only option. I'm thirsty. I want what I want. I pay more for it. We all pay more when we go to the movie theater, go to an amusement park, we go somewhere where we're kind of a captive audience and we don't have any other options. We're willing to pay more for that, right? It's really
it's convenient. You're paying for the convenience.
That's exactly right. Yeah.
Because our borrowers are no different. They really want to go get the cheapest interest rate possible. Guess what? Then go get a W-2 job. Go get your credit cleaned up. Go save up the requirement. But that takes time. That takes energy. That takes effort. And honestly, a lot of people, they want to take the easier path, which is they want it yesterday. I want it yesterday. That's why when you go past the Chick-fil-A at 11:30, the drive-through line is wrapped around the corner, but there's two people standing in line inside. It's a convenience factor along with it. And this is no different. If you really want to go shop and get a better deal, you can surely go do it. I mean, obviously, cash is always going to be your best option. Save up enough cash and go buy it for cash, and you don't even need lending at that point in time.
Yeah. So a lot of people that are newer real estate investors, or maybe people that are not real estate investors at all, they don't get this. They're kind of grown up thinking the American dream is home ownership. But let's be honest, I don't know what home ownership is today, around 65%, give or take a couple of points. 35% of the population doesn't own a home. And home ownership rates, they might be starting to creep up a little bit with some of the financing that's coming around lately. Is loosening up. But truthfully, 30% plus of the population will never own a home. And it's not that maybe they don't ever want to own a home, right? I mean, I know some pretty wealthy people that think home ownership is crazy. I don't necessarily agree with them. But at the end of the day, kind of where are we in the industry, the seller finance industry, right? And where have things been, and kind of where do you think we're going with the opportunity as a real estate investor, let's say?
Well, look, after 07, 08, pick a year, whatever, when the banks basically got their hands slapped, right? Things are forgotten in time. But as of today, and I think moving forward, when rates were 2 and 3 and 4%, it was even harder to get loans because the risk the risk outweighed the gain that a bank. So banks, they've already been told, don't do this, don't do that. So now everything is evaluated under a microscope. Everything that you've been asked to, you got to jump through all these hoops to go get a mortgage these days. And here's the problem. Unless you have something already pre-established or you pre-qualified, you go see something, you find a house that you like and you want to buy, there might be 2 or 3 or 4 offers that are all submitted simultaneously. Yeah. And by you not having the ability to go get that thing closed quickly and basically treat it as cash, it makes it extremely difficult for people to go buy. So it becomes a very frustrating process overall. So the seller financing, why it's beneficial for us, and I would say for the borrower at the same time, is we eliminate a lot of our competition on both sides of the fence. We eliminate the competition. If I have a house for sale on the street and there's 15 other houses for sale, and I'm the only one that's seller financing and everybody else has got it listed on MLS, I'm not competing against those guys. Because I'm offering a different product and service
Absolutely.
Than they are.
Yep.
It's like, if you got a family of 7, you're not going and shopping for a 2-door sports car when you go down the auto the car lot. You're looking for something that's going to hold your capacity.
Sure.
And there's no difference. We just came up with a system that really that not have to create internal competition amongst ourselves. And the way that we've done that is by providing a solution where other people have not. And that's
Right.
really the bottom line. We don't really care if 90% of the it's not supposed to be ringing. Sorry about that.
Sorry.
I'm not sure why that's doing that.
I thought the phone was turned off, but I guess it's not.
No problem.
Back to what I was saying. So, we just want to make sure that at the end of the day, we provide a service and a convenience, but we want to provide home ownership for those that want it. It's really that simple. At the end of the day, if you want to own a home and you're willing to do the necessary things that allow you to gain that, then we're here to help you. And that's it. That's the end of it.
And as investors, that's the opportunity that exists, right? The government isn't willing to subsidize those folks with bad credit. The big banks, Wells Fargo, all those guys are not willing to step in and say, I know you got a bunch of credit problems, but we're going to stand behind you here. Like, they're not doing it, right? So there's a gap in the market, and there are people that want to own a home that otherwise can't, right?
Yeah, and
so
that's
the void you're filling.
I mean, in a nutshell, that's it. It's like we're willing to solve a problem for folks and individuals that haven't been able to find a solution. Is it the best solution? Is it the only solution? No, but it's an option, right? And at the end of the day, they ultimately have to decide what's in the best interest for them and their family. Do they want home ownership at this cost or this expense, or would they rather to continue to what they've always been able to do?
Yeah.
And where I think this is going, I think it's only going to get more in demand because I think the sheer number of people that aren't going to fit that buyer's box is just going to continue to shrink.
Absolutely.
At the end of the day, it's just a matter of really providing an opportunity.
Yep. Nick, maybe take a couple minutes here. For those that want to get started in seller financing, you obviously have learned a lot along the way from the first deal you've done until doing hundreds of deals, just like anything. How do folks kind of get started moving down this path and make sure they're staying compliant and really understand the opportunity?
So you really got to break it down in the different phases. You have phases. There's what I call 3 phases in this process. Phase 1 is the acquisition or finding of the property. So you're taking the property down. Phase 2 is basically after phase 1 is after you fix it, you got to go find the buyer and you got to sell it and create the note. And then phase 3 is getting cash out for the note, selling the note, because unless you have a tremendous amount of working capital, most people aren't going to be able to keep every note that they write.
It's hard to have deep enough pockets to be the bank.
You run out of cash. I mean, I don't care how good of a deal it is, you end up running out of capital.
Yeah.
And then for the longest time, I mean, the first several hundred deals that we did, we had to sell the majority of those notes. But at the end of the day, it still made business sense to sell. In the beginning, you might be able to sell, 4 and keep 1. That's probably about the ratio right now that we're seeing. So somebody wanted to get into it, you gotta buy, fix, sell, create the paper, sell the note, do it again. Every 4 times you do it, you have enough money to basically keep 1 whole note yourself.
Sure.
And make 20, take all that money, then buy and keep the note yourself. So, forgot what I was going to say on the other side.
So in kind of terms of people getting started, the acquisition side is really no different than all real estate investing, finding deals. Different. We've talked about a million topics here on Flip Nerd. I have our coaching programs and all this stuff about how to find deals, right? Using traditional sources, direct mail, pay-per-click, whatever it might be. So you find them the same way. Then the selling part, that's one big thing, right? Like a lot of us kind of classically trained real estate investors, we focus a lot of our effort on finding deals. If I buy it at the right price, I'm not going to have to worry about selling it. On your side, you're selling it. You have to, and truthfully, I sell it to wholesalers, right, which we can build up a list of for years. I can sell it on the MLS, and so there's a marketplace there. But you're kind of selling, you could sell them on the MLS, I guess, but you kind of develop this selling strategy to sell into this pool of people that the traditional market has is kind of forgotten, right?
Yeah, exactly. Look, we'll sell to anybody if they got the money and they meet the terms and the conditions of what we're
Right.
trying to sell for. I don't really care.
Right.
But at the end of the day, you know, the whole objective of what we try to do is really understand what that buyer's criteria is and try to provide a service and a solution to meet it. You know, today.
Yep. Yep. And then the cashing out. And of course, just really understanding the regulations, right? Which is, we probably kind of agree the best thing to do is just go through an RMLO, which is kind of somebody that knows how to kind of tread you through these waters, right?
Yeah. I mean, it's real. So seller, you know, if you could break it down into just numbers, the number of steps in a wholesale transaction, let's just call the number 10. There's 10 steps from when you be able to find the property and be able to get paid when you sign it back out. Well, on a seller finance model and be able to create paper and sell the note, that's not 10, it's like 50. Right. So each one of those steps is a mini landmine, if you will, through the process. I would not say that seller financing is difficult. It's just very complex. Yeah. There's a lot of moving parts, and there's a lot of things, and there's compliance issues, and there's Dodd-Frank, and there's SAFE Act, and there's disclosures, and there's all kinds of things that need rules and regulations that have to be followed. Sure. There's ways to do all of that. We've done it for years. I mean, when we buy notes from investors that are looking to basically create this model, you know, we let them know exactly what the checklist looks like and make sure that all the T's are crossed, I's are dotted, because you don't want to write a note that is not a desirable, you know, instrument to sell, right? You want to be able to get cash for it, and you want to not only get cash for it, you want to be able to get the most amount of cash for it. Look, banks are doing that's what banks have done for years. As a matter of fact, I don't know the exact number, but I'm going to guess it's at least 75% of all loans that are written, they're sold the same day that they're closed. You go to Wells Fargo and get a bank loan for your home. The next thing you know, an hour later, you're getting a letter in the mail saying that your note's been sold. So not only did they sell the note, they sold it for more than what the note was actually worth. So you're not going to get 100% of what on a seller finance note is, because the borrowers aren't as pretty per se, because they don't check all the boxes. But you know, if you do a good job and there's enough, the right LTVs written, and the borrower gives enough down payment, you might get 90% of that note value. So sure. At the end of the day, that's how you can exit out of it and go on to the next deal. Yep.
Awesome. Well, Nick, thanks for sharing all this info with us today.
Excellent. Well, I appreciate you having me on, Mike.
Yeah, good stuff. Hey, if folks wanted to learn more about you or connect with you or anything, is there any place they can go?
Yeah, you can. The best thing to probably be able to do is just go to rylexcapital.com, RYLEX capital CAPITAL.com. That's one of our corporate sites, and from there you can. There's contact information, whether they want looking to buy notes, whether they're looking to sell notes, or just have any general information or any general questions they want more information on. You know, we work with guys, especially in the Texas area. I'm not real knowledgeable outside of the Texas market when it comes to the seller financing, because there's a lot of rules and regulations. It's more of a state mandated kind of thing. Sure. You know, Texas is you got land trust in some states, you got deed for trust and deeds in other states. You got judicial states here, and you got different foreclosure laws and things along those lines, and all those things have an impact on how a deal is structured. So really got to know what each market or each state's rules and regulations are.
Yeah, awesome. Well, we'll add a link down below for RYLEX Capital, and forgot to mention kind of early on that you're obviously a member of the Investor Fuel Mastermind. So we're really grateful to have you in that group. Your wealth of knowledge, and looking forward to seeing you at the.
I appreciate the invite. It's a great group of people, and I'll tell you what I like about it the most. And I've been around a while, and I'm still part of some other groups. But what I like about it the most is that the number of people that we have in it. And from my perspective, that's actually I didn't know that I would like that at first, because I've always sort of been involved in more of a smaller group, more intimate environment. Yeah. But I actually like the larger, because there's just more information, and there's just more opportunity, and everything is just times 10.
Yeah. And a lot of great people too with that, everybody's so open.
Yeah, it's so great. And I mean, that's the beauty of it, is that there's a place for everybody in there with the different groups that you have. You and Stinson have done a great job putting them together. I can't wait for the next one. And I'm working with Ted right now. Potentially having him helping working us build a new inventory for so we can.
There's a lot of people in the group that are starting to work together and do deals together and stuff. So
yeah, it's great. And so
awesome.
Hopefully people listen in, they'll check it out, and maybe
we'll add a link down below for Investor Fuel as well for anybody that's interested. So awesome. Hey, thanks again, Nick, for all your time. Really appreciate it.
Hi, buddy. We'll see you soon.
Yeah. Hey, everybody. This is episode number 429 with Nick Legamaro. Really a wealth of knowledge in the seller finance industry, and he's got a lot of great information he shared here today. So hope you learned a lot. If you haven't yet, please subscribe to us on iTunes, Stitcher Radio, Google Play, YouTube, wherever you watch us at. Of course, you can see all of our shows and listen to all of our shows or watch them on flipnerd.com, where we have over 1,500 different podcasts that we've created over the years. So lots and lots of great information on flipnerd.com. But appreciate you all. Hope you got a lot out of this show. We'll see you on the next one.
Thanks.
If you're an active real estate investor already doing deals and looking to double or triple your business, you should consider joining the Investor Fuel Real Estate Investor Mastermind. We're a small group of investors that share our best practices, tips, and tricks with one another in an effort to all win. Real estate investing can be a lonely business for successful real estate investors, but it doesn't have to be. Investor Fuel members meet 4 times a year, but we talk to each other 365 days a year, and we focus on improving the profitability of our businesses, improving the quality of our lives. That's why we do this, right? And making an impact on those around us so we can truly leave a legacy. We limit our membership to only 1 to 2 members per market, so everyone shares their knowledge, tips, and tricks openly and honestly. Our members include some buying 1 to 2 houses a month, up to some of the most respected investors and leaders in the real estate investing industry, some of which have personally done over 1,000 deals. If you'd like to be considered for our invitation-only world-class mastermind, please visit investorfuel.com to request your personal invitation. Our next meeting is coming up quickly. Go to investorfuel.com now to learn more. Thanks for joining us for this episode of the FlipNerd.com Investing Show. If you're not yet an elite member of FlipNerd, you're missing out. We have tons of great training, including a new detailed master class published each month and live training webinars with experts twice a month. Plus, you'll get access to all of our archives, where we already have a growing library of master classes and other training videos. Elite members also get membership in our incredible online mastermind group, where many of the top real estate investors from across the country, including many of the hundreds of guests I've had on the show in the past, are already members. Whether you're brand new, looking to get started, or a veteran, you simply must join today. I promise you won't be disappointed. To learn more or join today, please visit flipnerd.com/lab. That's flipnerd.com/lab. See you on the next show.